Okay, let's get right into it. We tend to think market crashes are these totally random, out of the blue events. But what if they're not? What if there's a predictable pattern? What if, right before every single major collapse, everyday investors all start crowding into the exact same kinds of stocks? Well, that's the pattern we're going to break down today. So, what's the common thread that ties all the biggest crashes together? It's not some random piece of bad news. The data shows it's actually a very specific, very human behavior that pops up time and time again, acting like a giant flashing red light. And you can see it right here throughout history. I mean, look at this. In 2000, before the dot-com bubble burst, everybody was piling into tech stocks. 2008, it was all about financials. And more recently, in 2021, the craze was for those high-growth tech and meme stocks. You see the pattern, right? A certain type of stock becomes the crowd favorite right before the whole thing falls apart. So let's get specific. We're going to walk through the 5 types of stocks that historically get dangerously popular just before a market crash. You can think of these as the 5 biggest warning signs you can learn how to spot for yourself. First on the list, high-growth, no-profit tech stocks. Oh yeah, these are the darlings of the bull market, the companies everyone is buzzing about. They have this absolutely jaw-dropping revenue growth, over 30, 40, 50%, but they're burning through cash. There's no actual profit. Their entire stock price is built on a story, a promise of what they might become one day. And that, as we're about to see, is a very, very shaky foundation. And when reality hits these stocks, it hits hard. Just look at 2021. Companies like Peloton or Zoom were trading at these just insane valuations. We're talking 15 to 30 times their sales, not their profits. But the second interest rates started to tick up, that promise of future profits felt a lot farther away and a lot less certain. The result? A complete and total collapse, with many of these stocks just plummeting over 70% from their highs.
And that brings us to a really simple rule of thumb. If you're looking at a company and its current stock price needs a solid decade of absolutely perfect, flawless growth just to make sense, it's not a good investment. It's a prime crash candidate.
All right, number 2 on our list, meme stocks. Now, these are a bit newer, but they follow the exact same dangerous pattern. Their prices have nothing to do with earnings or revenue. Nope. It's all driven by Reddit threads, social media hype, and these grand stories about short squeezes. It's pure emotion, totally disconnected from how the business is actually doing. And the meme stock story always has 2 parts. First, you get the crazy, intoxicating hype, right? A stock like GameStop rockets up 1,700%. It's incredible! But then comes part 2, the crash back to reality. An 80% drop, a company that's still losing a ton of money, and a history of selling new shares just to stay afloat. The online hype always fades, but a bad business model, that sticks around.
This leads to our second big rule, and it's a simple one. When a stock's price chart goes completely vertical, but its financial reports are flat or even going down, you're not seeing a miracle. You're watching a crash being built, piece by piece. Okay, our third category is a little sneakier. It's cyclical stocks right when they're at their absolute peak. We're talking about companies in industries like cars, steel, or computer chips. Their profits are completely tied to the economy. So when the economy is booming, they make a ton of money. But when it turns, their profits can just fall off a cliff. And this is what's known as the peak earnings trap. It's so easy to fall for. You see a company with record-breaking profits, and its price-to-earnings ratio, or PE, looks amazing. Maybe it's only 5 or 8 times earnings. It looks so cheap. But that's the trap. As soon as the economy slows down, those record profits disappear. Sometimes they even turn into huge losses. And all of a sudden, that cheap PE ratio goes to infinity. The stock is now terrifyingly expensive. So the rule here feels completely backwards, but it is absolutely crucial. For these kinds of stocks, you never, ever buy them when they look the cheapest, because that is almost always the moment they are at their most dangerous peak. Moving on to number 4, and this one might give you some 2008 flashbacks. Over-leveraged financial stocks. These are the banks, the lenders that use a ton of debt to pump up their profits. On the surface, they look like these unstoppable money-making machines, right up until they're not. I mean, just think of Lehman Brothers. Now, the red flags for these companies are usually hidden deep in their financial reports. You have to look for things like really high debt-to-equity ratios, which just means they owe way more than they own. You'll also see them making loans way too aggressively, or even using accounting tricks to pretend bad loans are still good, all to keep their profits looking artificially high. So here's the rule. You gotta look behind the curtain. A high return on equity or ROE looks fantastic. But if the only reason it's so high is because the company is loaded up with debt, with leverage, and not because it's a great business, then that company isn't strong. It's fragile. It's a house of cards waiting for one little push to come tumbling down.
And that brings us to our fifth and final category, and it's probably the most ironic one of all: safe blue chip stocks. Yeah, I'm talking about the household names, the amazing companies that everyone knows and loves. The problem is, late in a bull market, everyone gets desperate for safety, and they all rush into the same stocks, pushing their prices into the stratosphere and making them anything but safe.
This slide just shows that paradox perfectly, doesn't it? On one hand, the perception is safety, quality, a fortress. But the reality, because the price is so high, is extreme risk. You start seeing PE ratios that are way above their normal levels, often right as the company's growth is starting to slow down. At that point, there is absolutely no room for error.
And this brings us to one of the most fundamental, most important rules in all of investing. I don't care how great a company is. If you pay too much for its stock, you are making a bad investment, period. A great company at a terrible price is a terrible investment. Okay, so we've gone through the what, the 5 types of stocks that become popular. But now let's talk about the why. What's the psychological engine that powers these bubbles again and again?
You know, the anatomy of a bubble is amazingly consistent. It's like a 4-step playbook. First, you see record amounts of cash pouring in from retail investors. Step 2, valuations get stretched way beyond historical norms. Step 3, you start to hear the 4 most dangerous words in investing. This time is different. And finally, step 4, the actual business fundamentals get thrown out the window. Nobody cares anymore.
And this right here is the key insight. This is so important. A market crash doesn't start because some bad news hits the headlines. It starts when there's simply no one left to buy. It's when every single optimistic person is already fully invested and feeling great that the market is at its absolute most fragile point. So, with all that said, how can you actually protect yourself? Look, this isn't about trying to perfectly time the market. That's a fool's game. It's about having a mental toolkit that helps you navigate these cycles of greed and fear when they inevitably show up. And it really comes down to these 3 things, the 3 keys to survival. First, read the company's financial statements, not the flashy headlines. Second, base your decisions on valuation, not on social media hype. And third, learn to understand and respect that markets move in cycles, instead of just getting carried away by your own emotions. We'll end on this one thought. The market doesn't just crash out of nowhere. It crashes when the riskiest assets out there start to be seen by everyone as the safest bets. So the ultimate question you have to ask yourself right now is, are we seeing that happen today?